Chapter 7, Financial Management. Financial management is about managing the financing for consumption and investment. You have two sources of money: money that you make yourself or money that you get from someone else. So you need to decide when to use whose money and how to do so as efficiently as possible, and thus maximizing the benefit while minimizing the cost. Financing can be used to purchase a long-term asset that will generate income, reduce expense, or create a gain in value, and it's useful when those benefits outweigh the cost of the debt. Recall in Chapter 1, we learned about the micro or personal factors as well as the macroeconomic factors that can impact our decision-making. So for a long-term asset, maybe buying a house is more useful and efficient if you have a large family. Whereas with the macroeconomic factors that we're seeing right now in terms of economic cycles, employment, inflation, interest rates, that's going to affect your financial decision-making as well. When it comes to cash, most people use a checking account as the main way of managing cash flows for daily living. So this is your bank account where your money gets put into or your income gets deposited and issued for operating. So expenditures, your money payments go out from this checking account. And while it's called a checking account, the actual depositing of paychecks and writing checks is not as common as it used to be because of the ability to do things electronically now. For instance, you can get your paychecks direct deposited into your account so that your employer is sending it electronically. And a lot of times banks will offer free checking if you set up direct deposit. Using direct deposit is considered more secure and efficient. Similarly, withdrawals or payments can be done electronically, like through automatic payments, where you have scheduled your payments to automatically get sent to your creditors at regular intervals, say on a monthly basis. Common examples include car payments, mortgage payments, or even your cell phone bill. The automated teller machine, or ATM, is a machine where you can deposit your cash or checks, as well as pull out money from your banking account. To do so, you will need a debit card that will allow you to pull the money out of your ATM. You can also use the debit card to pay for things, whether you're going grocery shopping or paying for gas, for instance. The money will be taken directly out of your account and transferred to whoever it is you're paying. And last but not least, you may have a savings account as well in addition to your checking account, and that's the money you set aside for savings or for later use. I find it helpful to have a limited amount of money in my checking account and my savings separated so that I don't touch it. It also helps in case there may be fraud or someone steals from your checking account. There's only a limited amount of money in there. So I usually only try to keep what I need to pay for my bills in my checking account and the rest in my savings. So let's talk a little bit more about your money that are in savings. The markets for liquidity are referred to as the money markets and the capital markets. Money markets are used for relatively short term, like a year or less, and are considered low risk debt. An example would be U.S. Treasury short-term debt, which are called T-bills, whereas capital markets are used for longer-term, higher-risk debt. So if you're saving or investing for a long-term goal like your education or for retirement, it's more likely you'll be using capital markets because there's a longer time horizon, which allows for greater use of risk to earn return. For most individuals, access to the money markets is done through a bank. And so the bank acts as an intermediary or middleman between the individual lender of money, the saver, and the individual borrower of money. Banks screen borrowers to minimize risk and manage and collect loan payments. With that reduced risk, the bank can attract lenders and diversify its supply. So through diversification of different sources of money from people and this expertise in screening borrowers, they're able to lower the cost of lending and borrowing liquidity. So here are a variety of banks. Retail banks focus on consumer saving and borrowing, while commercial banks focus on operating cash flow management for businesses. So the largest banks in the U.S. are commercial banks. Investment banks focus more on long-term financing for businesses. Central banks are public institutions that are responsible for managing monetary policy of a country. So for us, that's our Federal Reserve. Credit unions are not-for-profit financial institutions, and they act just like a regular bank. You might have seen them around town, like San Diego County Credit Union or Mission Fed, for instance. Now, growing in popularity are online banks, so they don't have a physical bank, usually. And you can usually get some benefits from it because nowadays, so many folks use online services, and saving and lending is just another service that you can do online. Mutual banks or mutual savings banks are similar like credit unions. They are community-based institutions, but while credit unions are nonprofit, mutual banks are for-profit and FDIC insured. And last but not least, savings and loans provide very similar services as other banks. They were created to provide more economic opportunities to the middle class, and some are private, while some are mutually owned by customers and some are publicly traded. Now, once you figured out what kind of bank you want to bank with, it's helpful to understand the savings instruments that you can choose from. So checking accounts are an example of a demand deposit, and they earn very little to no interest, but allows you to pull out your money anytime you want. Savings accounts or time deposits offer a bit more interest, but not that much more. And there may be some minimum deposit requirements or some withdrawal constraints, like you can only take out so much. Now, if you are willing to give up more liquidity, meaning you don't need access to your money at the moment, certificate of deposits or CDs offer a higher price for liquidity. So you'll get a better interest rate, but you have to commit to a certain time period of leaving your money in the account. Otherwise, you'll have to pay a penalty for early withdrawal. CDs come in different maturity time periods, anywhere from 6 months to 5 years, and they may have minimum deposits. Banks can also offer investments in money market mutual funds or MMFs, and these are invested in the money markets and again offer you a better interest rate or higher price for the liquidity because your money is put in slightly higher risk investments. When compared to capital markets, these money markets have very little risk. So MMFs are very low risk investments, and the trade-offs between liquidity and return can be seen here in the graph. So as long as your money's in your account, including any interest that was earned while it's there, you're going to earn interest on that money. If you don't take the money out and it gets added to your principal balance, then interest will accrue on both. This is referred to as earning interest on interest or compounding. Now, the rate at which your principal compounds is the annual percentage rate or APR that your account earns. And we learned about this back in Chapter 4, where you can calculate the future value based on what's currently in your account or your present value. Now, after you figured out what kind of savings instrument you want, there are saving strategies you can consider. So one I wanted to highlight, for instance, is CD laddering or certificates of deposits. Now, let's say I've got $4,000 and rather than putting it in my savings account, I don't need it right away, I can put it into a CD. And I'm going to break my $4,000 up into $1,000 increments. And so let's represent each one of these is $1,000. And what I'll do is that first $1,000, I'll put that in a 1-year CD. My next one I'll put in a 2-year CD, a 3-year CD, and a 4-year CD. And so what that does, it staggers the time period in which the CD matures, and I can pull that money out. And you'll typically notice that the longer the CD, the interest rate will be better or higher. So after my first CD matures, reaches that 1-year anniversary date, I can decide, do I want to pull it out and use it for something, or do I want to reinvest it? And if I'm reinvesting it, it's the original $1,000 plus any interest I earned on it. And so, for instance, here, I can go ahead and put it into a 5-year CD. And now you might ask, like, whoa, 5 years is so long. First you had it in 1 year and now you're putting it in 5 years. Just remember though, I have another CD here with another $1,000 that will mature a year later at the end of year 2. So you can see that as my CDs mature, one is always going to become available each year. So maybe in my second year, when that matures, I can decide, do I need to take it out, or do I want to reinvest it? And I can go ahead and reinvest it in another 5-year CD, and then wait another year, see how things go. And my third CD here, the one that was invested in a 3-year CD, again, I make that choice. Do I need to pull it out? Oh, I've got something I want to buy, or do I want to reinvest it? And this continues on. And you can see that as this one, for instance, comes up on at the end of year 4 and the start of year 5, I can decide to use it or not. But my next CD that's going to mature or be available to pull out will be around year 6, that first one. So laddering will allow you to earn interest on your savings while keeping you somewhat liquid on a regular basis. So you just have to plan for it and be aware that when the money will become available, so that you're not pulling it too early and getting penalized. If you decide you want to use other people's money, this is known as credit, and it's used to buy goods and services, to finance living expenses, or to make payments more convenient by delaying them for a short period of time. Whereas debt is used to finance the purchase of assets like a car or home, rather than delaying payment for recurring expenses. So it's really important we understand the difference, because this is going to impact the way you manage other people's money for your own purposes. Credit is issued either as installment credit or revolving credit. Installment credit is used to purchase consumer durables, usually issued by a vendor for one item. Like when you buy a couch from a furniture store like Living Spaces, they can offer you installment credit with payment plans to pay off that couch. Whereas revolving credit, which is the more common one that we see, is when a creditor extends the ability to delay payment for different items from different vendors. So credit cards is usually where we see this. Credit cards are often lent by a bank or finance company and give you like a charge card or a credit card to use. Now, the difference between a charge card or a credit card is that with a charge card, you have to pay off the balance in full each period or credit cycle. Whereas with a credit card balance, you usually only have to pay a minimum payment, although I would still recommend trying your best to pay off the full balance in your period or credit cycle so that you're not accruing interest. Lenders will measure risk through credit ratings and reports to figure out who are less risky versus riskier borrowers. So credit rating agencies specialize in evaluating a borrower's credit risk or default risk for lenders. And what this comes out with is a credit score, which lenders use to determine their willingness to lend you money and how much it's going to cost you. So the 3 major credit rating agencies are Experian, Equifax, and TransUnion. And when they create your credit score, they may vary because of the different ways that they evaluate borrowers. But generally, the range of scores are going to be somewhere between 300 to 900. And ideally, you want a higher score, because the higher score, that means you appear less risky. The factors determining your credit score are your payment history. So do you make payments on time? The amounts you currently owe. So what's your balance out there? Do you have a lot of money in your balance? The length of your credit history. So how long have you had credit? Like if you think about your credit cards, how long have you had them, or what loans, how long have they been in place? New credit, so have you been getting a lot of new credit cards recently? And that could be a red flag. And then the types of credit you have. Is there a mix of, let's say, a loan versus credit cards, etc.? Something to be aware of, though, is that identity theft is a growing problem. And this happens when someone pretends to be you because they have access or they've gotten your personal information like your social security number, driver's license, bank account numbers, or credit card numbers, and then use that information to steal your money or make purchases. This is why it's so important to check your credit report regularly, because you'll be able to see if anything strange is happening under your name. And then also if you have credit cards, to look at your statements to look for fraudulent activity. Oftentimes credit card companies will contact you if they see something strange, but they don't always catch things. So you have to be looking at your statements as well. For example, 2 Christmases ago, I saw a like $5,000 charge on my credit card that I did not make, and I was able to get my credit card company to reverse it. So credit cards are very commonplace, and they're used because they're convenient and secure. As I mentioned, I was able to get my credit card company to reverse that fraudulent charge, and merchants worldwide accept credit cards as a method of payment because the bank or finance company that is behind that card has assumed the risk by guaranteeing that vendor or merchant's payment. And if you notice nowadays, less and less people use cash because they don't want to lose it or get it lost or stolen. So credit cards are safer in that way. And credit cards track what you're spending in your statements so that you can see your behaviors and have good record keeping. Whereas with cash, you use it, and unless you're keeping all the receipts carefully, you may not realize where you're spending your money. So when you are using that credit card, something to be aware of is the grace period. This is the time between when you make that purchase on your credit card and when you make the payment, assuming your beginning balance is 0. Credit cards are a good cash management tool if you're able to pay the balance before interest accrues, meaning you're using someone else's money to make your purchases at no additional cost. Problems arise when you're actually financing purchases past the payment deadline. And that's when interest charges accrue and then can compound to a larger APR. Now, I often hear from students that they don't have or they don't want to get a credit card because they're afraid of these problems. They're afraid of going into debt, which is a valid feeling. And that's why it's important that if you are going to get a credit card, that when you're making decisions about what you're purchasing, that you're not buying things beyond your means or spending more than you make, right? And so as a cash management tool, it can be more secure. It can help you keep track of what you're spending as long as you're able to pay off the balance or pay off the balance relatively quickly. So if you do have to keep a balance, it shouldn't be there too long. Again, the interest charges that accrue can end up costing you a lot. When choosing a credit card, you want to shop around for credit just like you shop for anything else. It's helpful to compare the features and costs of the credit card. So what's the credit limit? How much is the credit card company going to offer you? What's that grace period going to be? Are there any purchase guarantees that they offer? Like if you buy something defective, you can get the charge stopped and removed from your bill. What are the liability limits? Like if the card's lost or stolen or something happens, like a fraudulent charge, are you responsible for anything? Most cards offer consumer rewards or points, which you can get cash back or you can use it for travel. And then there's the APR. Is it fixed or adjustable? Oftentimes credit card companies will offer an initial APR of 0% to get you using the card. But then at some point it will jump up to a higher rate, 10%, 14%, even up to 20%. So you want to be careful and understand what that looks like. And in terms of the adjustable, that might change based on the age of your balance. Like your rate may rise if your balance is over 60 or 90 days. And then are there late fees charged if you don't make your minimum payment on time? Are there fees on cash advances, meaning you're pulling cash through your credit card, which I don't recommend doing because usually those interest rates are much higher and compound differently. Or is there fees on balance transfers? So if you're moving your balance from one card to another, what do those fees look like? And then some cards charge an annual fee for having the card. Now, if you're using credit cards as a cash management tool, and you pay your balance every month, then the things that you would care about most would be like the annual fee. Try to find one that doesn't have it. Or if there's any cash advance charges. Again, I recommend don't doing cash advances ever if you can help it. And then if you know you're going to sometimes carry a balance, you know you're going to use money to purchase something, but you won't be able to pay it off right away, then you want to focus on finding one that has a lower APR. So because of the late fees and compounding interest, if you don't pay your balance in full each month, it quickly multiplies and gets harder and harder to pay. This is where you might get into some credit troubles. So some things that you can do if this happens is first, set up a realistic budget that is going to help you figure out how to pay off the balance. figure out what your balance is, see how much you can put towards it each month, and then make sure you follow that budget until you pay off the balance. You may need to contact your creditors and explain that you're having financial troubles right now, and that you plan to make your payment. So informing them is helpful because you don't want them to turn your account over to a debt collector, and maybe there'll be a way for you to resolve that debt more proactively with your creditors. It might be helpful to get a credit counselor, someone that can kind of coach you through and help create that budget and negotiate with creditors to consolidate that debt, for instance, or manage it. You want to be careful, though, that sometimes credit counselors are actually creditors in disguise, and they're just trying to make money off of your problems. And then as a very last resort, you might have to file for bankruptcy. This hurts your credit for 10 years, and it will make it very difficult and expensive for you to get and use credit over this time period. So it's going to cost you in the long run anyway. Now that we've talked about credit, which is used for short term, let's talk about debt, which is the long-term version of credit. And this allows us to delay payment over a longer period of time or several periods. The two most common uses of debt by consumers are car loans and mortgages, or loans to buy a house. And you'll learn more about these in chapters 8 and 9. Now, lenders face two kinds of risks when loaning out money. There's default risk, which is the risk of not getting paid. And they'll use the 5 C's that we'll talk about more in depth to figure out what that risk looks like. And then there's the interest rate risk. So this is the risk of not being paid enough to outweigh the opportunity cost and make a profit from lending. So this is tied to the prime rate. So this is the rate that banks charge their very best or least risky borrowers. And so if interest rates go up before your loan matures, then the lenders suffered an opportunity cost because they could have earned more money if they were loaning that money that they loaned to you at a higher rate. So for instance, my interest rate on my home right now is 2.75%, really low. And because that interest rate is locked in for me, they are missing out because they could loan that money to someone else at a much higher rate right now due to the interest rates being what they are. So let's dive deeper into the 5 C's, which is character, capacity, capital, collateral, and conditions. Character is the assessment of the borrower's attitude towards debt and its obligations. To figure out someone's character, they'll usually look at your financial stability, your employment history, where you've lived, for how long, and your repayment history on prior loans. So this will let them see your, trustworthiness, personality, and credibility. Capacity represents your ability to repay by comparing the size of your proposed debt obligations to the size of your income, expenses, and current obligations. The higher your income is in relation to what you're obligated to pay, the more likely you're able to, make your payments. Capital is your wealth or asset base. So you can use your income to meet your debt payments, but you can also use your asset base or accumulated wealth as well if your income falls short. Thus, it demonstrates your level of commitment. Conditions refer to the lender's assessment of what's going on right now in the economy. So is the economy headed for a recession and potentially higher unemployment rates, which might affect your ability to earn income and repay the loan? Right now, we're experiencing inflation, so will interest rates rise and the value of currency fall? And then last but not least is collateral. So this insures the lender against default risk by claiming a valuable asset in case you default. So if you default on your loan, they can take back your car or your home, for instance. Please remember, in terms of appropriate uses for debt, debt should only be used to purchase assets, not to finance recurring expenses. So I made this mistake after graduating college. I was using credit cards to finance my recurring expenses, going out to eat, vacations, traveling, buying clothes, and not paying the balances in full and accruing interest. In less than a year, I accrued $10,000 in credit card debt. But at the same time, I was making good money, but I wasn't using that money appropriately or managing my cash to pay off my recurring expenses. Instead, I was sticking it in retirement and putting it in savings, sitting there, not accruing interest. I didn't understand how I was managing my money and how it impacted me in different places. So once I realized what I was getting into, I cleaned up my act, paid off my balance, and then made sure that going forward, I always paid off my balance at the end of each month, so I wasn't accruing interest, and appropriately setting aside the right amount for my savings and my retirement, and building up my credit so that now I can buy a home, I can get a car at good interest rates. So whether it's cash, credit, or debt, you shouldn't be afraid to use money, whether it's your own or others, but it's really important to understand how they all work together and how best to use them to maximize the benefits while minimizing the costs.